When your options are limited, so are your opportunities. At Cboe, the global exchange that pioneered options trading, we offer more ways to move with the market. From VIX and SPX options to global market data solutions, Cboe helps investors diversify, manage risk, and stay ahead of whatever the market does next. Cboe. Life is better with options. Your investments could be too. There are risks associated with Cboe Company products. Review the disclosures and disclaimers at cboe.com/US_disclaimers.
The views expressed on this podcast are those of the participants, not of Reuters News.
The artificial intelligence boom is entering a new and frothier era. From the moment OpenAI released ChatGPT in 2022, tech giants have raced to expand and perfect the technology, with US titans like Amazon, Microsoft, Google, and Oracle set for over $600 billion of capital spending as they rush to build data centers in the coming year. After practically tapping out spending capacity even at hyper-profitable firms like Facebook owner Meta, which is promising to spend 78% of its expected cash flow in 2026, and drawing in a host of upstarts like server farm builder CoreWeave, the AI leaders are now turning to debt, issuing vast sums to keep up the pace. What this means and what the potential risks are is the focus of this week's Viewsroom. Welcome to the Viewsroom, the weekly podcast from Breaking Views that dives into the knottiest issues in corporate finance and business. I'm your host, Amy Donlan.
And I'm Jonathan Guilford. Amy, as our resident US correspondent on big private lenders like Apollo or Blackstone and so on, I'm kind of going to be playing both host and guest this week. But it's a fascinating moment to be covering this stuff. This whole industry among the private lenders that we used to talk about as this sort of poor cousin to banks' leveraged lending desks is now much meatier. It's setting its sights much higher. And AI is just a huge part of that growing up moment. Private lenders have been straining for a long time to get behind something much more important than, the kind of like business of just financing buyouts or what have you. And yet, just given the size of this, it's also a story about in the entire credit market, right? From traditional bonds through to all these finicky and complicated structured financing deals. Like this is just encompassing everything right now.
Absolutely, absolutely. And I think, as you said, it's such an interesting moment, right? Because it can draw all the comparisons from like telecoms companies in the dot-com era. There was the shale oil drilling and that whole boom. And I always think when a sector starts raising debt in quite a big way, even if they are very profitable, it certainly catches the attention of Breaking Views, would you say?
Yes, no, most absolutely. And fortunately, it's also caught the attention of our guest this week. Neil Ermack is our credit guru sitting in Breaking Views London office, and he's going to join us to talk through this week. Neil, you are very welcome to the Viewsroom.
Thank you.
So just to set the stage a little bit, the numbers we're talking about really are vast, right? Because Neil, you've been looking through some of this, and I think you had a report saying like the $700 billion of loans and bond sales from the tech industry thus far this year. Spending commitments, as Amy was saying, are only going up. Can you just help us contextualize that a little bit? Is there any precedent for this?
Sure. Well, I think the big sort of trend that we've seen in the last couple of quarters has been the emergence of very large bond issues by the hyperscalers, the Oracles or the Metas. And so that of that 700 billion of funding this year, which is data from UBS, I think about 190 has come from the large sort of investment grade bond market. So that's kind of the big new trend, and it's only likely to continue. As you highlighted at the start, we're looking at sort of something like 600 billion of capex next year. I think UBS is forecast for 900 billion of total tech funding in the debt markets next year. And the really big question is quite simply, how much capex will there be in the following years? Will it tail off after a couple of years, or will it just keep going up and up and up? And at the moment, no one really has a clear handle on that. But the clear takeaway is that all of the debt markets are going to have to absorb a substantial amount of new paper.
And Jonathan, we're going to have to ask you to play host as well as guest in this, because you are something of a private credit guru. So I'm curious, how does private credit play into this whole situation, which Neil has very nicely just kind of laid out?
Sure. So, I mean, as I was kind of saying before, like the private credit industry, which again is these big, really like buyout barons that ended up moving into lending in a very, very big way. They used to be really focused on this kind of junk rated buyout business, like smaller companies. And that was a great business. They grew to like vast size, financing that. That was a, very, very good run that they had for a while. But they need more. They're talking about, addressable markets running into like the trillions of dollars, the tens of trillions of dollars now. And AI is like right in the center of that. And of course, if you're one of the big firms, the thought being like, oh, this is a place where I can be different from a bank or private lender X, Y, or Z. I am I am Blue Owl, I am Apollo, I am Blackstone. I'm big enough to do this big stuff. And so you've seen like Blue Owl did a $27 billion deal with Meta to help fund its Hyperion data center. You have all of these data center platforms that the private lenders' buyout arms have acquired. So like Blackstone has QTS, BlackRock, which, has just been getting into private markets recently, just did a big data center deal. You have Brookfield doing this huge infrastructure program with NVIDIA, which is like 100 billion top line. And I think it's like 3-to-1 levered is kind of like the idea there. So like it's a ton of debt that they're putting into all this stuff. And for them, it's great because their whole business is we want to print as much safe but like high yielding debt as possible. And then we can sell and parcel that up to investors and increasingly to insurance companies who all need to get these kind of like steady returns. And, people are like, oh, okay, so this is all backed by this huge industrial change that's happening.
So Neil, I feel like, we have written about throughout the years of, as I said, industries taking on huge amounts of debt. But it all sounds from what Jonathan's saying like so far so safe. So what do you think the risks here? Because you're talking about companies who are extremely profitable, who are really at the sort of vanguard of, this renaissance, this huge moment for the world. So what is the risk of them taking on all this debt and the people, I guess, who are lending to them?
Sure. Well, I think you're right. I mean, the obvious precedents are the dot-com boom or the shale boom, both of which ended with a wave of essentially defaults and losses for bondholders. The big difference, I mean, as you say, there are a couple of big differences. One is the starting debt position of many of the companies that are doing this. So the Amazons, the Metas, they all have very, very little debt, with the possible exception of Oracle. And so that ultimately means that even if they substantially increase their capex, there's a limit to how much their debt will increase, at least over a 1 year or 2 year horizon. The other big difference, of course, is that they're growing very, very, very quickly. And so long as the rate of AI adoption keeps up, then that growth will continue to come through. But there are quite a few risks around that. We don't know how much capex they're really going to need, how long that capex boom will go on for. We don't really know what kind of obstacles there could be thrown in the path of AI adoption. So I think there are still quite a few variables here that make it hard to really assess what the endpoint is for leverage.
Yeah, and one thing that I think it's important to keep in mind under all of this, right? Like you say, these are very profitable companies. This is a very, very fast-growing area. But there's this other little bit of it too, right? Which is, even though AI is this, entirely digital thing, it's kind of, we think of typical insubstantial software markets. This is all asset light. There's a ton of like hard physical goods sitting underneath a bunch of this. And you've seen a ton of the financiers begin to take that into account. So we had XAI reportedly doing a special purpose vehicle where they were kind of like throwing chips into there. They were leasing them back out. They were able to leverage up the thing that was holding the chips based on the value of those chips. You have data centers like Blackstone really pioneered this back when it acquired QTS, like putting on a ton of leverage with through the commercial mortgage-backed security market effectively. So essentially what you're saying is like, look, I have these buildings, I have this land, I have this power, I have all these servers, I have all this stuff. Like all of this can be levered up because generally people begin to feel safer when they're like, oh, okay, if stuff really hits the wall, I can always take back the assets at the end of it. Of course, slight problem. We're in year 2, 3 of the AI boom. Nobody actually knows how much this stuff is going to be worth as we go on. We've already had multiple huge shocks from DeepSeek through to now everybody's worried like, oh, Google's in-house chips are great. Like, what does that mean for NVIDIA and so on and the residual value of all these chips? So like there's a big risk there that this, kind of financial model that was pioneered for basically cars. Like that's what it was meant for. Originally, it was to kind of help finance like car loans because you can always take back a Toyota Prius or whatever. And we have a pretty good sense of what a Toyota Prius is worth. I don't think the Toyota Prius will disappear as an asset class next year. But like with chips, it's like just all much more difficult to figure out where this goes. And people have been somewhat tentative about that, but it's still a thing underlying all of this, right?
And I guess that also, the other point there is simply the scale of interconnectedness between all these different markets, that because of the amount of funding that is needed, the sector will tap, as you say, the CMBS market, the private credit market, the public market. And if one of those areas gums up, if one of those channels breaks down, then it puts pressure on the other ones too.
Well, the other thing I was kind of curious about is I think we all know you don't really know you're in a bubble until I guess it bursts or it starts to look like it's about to burst. Is there any signs that you think, Neil and Jonathan, that we are in a bubble, that this is starting to become excessive, that the debt is, is being let, I guess you always think when lending standards start to kind of fall down, when I guess companies start to lend more than you think that they should, that sort of makes sense. Are we anywhere near that yet?
So it probably didn't help that like the boss of OpenAI mused about, oh, are we in a bubble? And when you go to San Francisco and you meet with like VCs and everything, part of this is people annoyed that they can't, like their capital doesn't allow them to discipline these young companies as much anymore because they're all growing in valuation so much. They have like a different sort of negotiating leverage with VCs than they used to. But you do hear people musing like, oh yeah, no, this is totally a bubble. Like this is crazy. There are a ton of early valuations and so on. Less so clear, like when you come to just, again, like the big tech companies are so fantastically profitable. Like that's the thing that you always run up against. Maybe that is kind of irrelevant to the question of does all this spending make sense? Like, yeah, you're making a ton of profit, great, but incrementally would the story be that much different if there weren't a ChatGPT or whatever? And I don't know, Neil, if you like kind of have a different view on that, but.
Yeah, I guess the other point there, though, is simply that at the moment, investors, at least in the investment grade debt world, are not getting paid very much for taking this kind of risk. So if they're currently getting paid, 60 basis points over government bonds, and yet it turns out that the capex needs will go on for 5 years at sort of 700 billion for the sector, then that ultimately means that you end up in a much more levered place at the end of that. And the extra return that you need to fund those companies will go up. And that obviously will lead to losses for investors.
Right. That's kind of the maddening thing, right? Because when you look at AI from the point of view of the companies or equity investors or whatever, you ask the question, oh, what is the return on investment here? And it ranges all the way from, oh, chatbots are a great new subscription product. We're going to sell the next new enterprise SaaS solution, yada, yada. And it goes all the way up to, oh, yeah, we're building a digital god and it will be able to grant your wishes and it can do anything. So like if you are a company or an equity investor, you can tell yourself, great, I'll do any amount of investment for an option on infinity. But for credit, it's like you're saying, Neil, right? Like it's a totally different setup.
Yeah, that's right. Ultimately, your upside is capped and your downside is not, obviously it's not infinite, but there's quite a long way it can go.
And so does this maybe, Jonathan, maybe I guess as sort of the last question about the spread across the market, right? So there's so many different types of sort of lenders now, right? And as you said, keen to get in on this infinity trade. And what are the sort of risks of that? So it goes beyond banks, let's say. It just anyone basically wants to lend into this market.
Yeah, I mean, okay, can I do a tiny bit of a rant here?
Yeah.
Essentially, like what you had with private credit, right, was, and like Neil is also, I'm sure you'll have your views on what's going on in the private credit market, but you had, again, this sort of young thing that grew up. It was just about largely financing buyouts and whatnot. There was other stuff and whatnot from the beginning, but that was a big part of the big puzzle. And then it's bloomed out into this whole thing where you really have like the Apollos and KKRs and so on of the world saying like, okay, we've built this gigantic machinery, which is like, we own insurers, and the insurers need a bunch of kind of like steady paying debt that they can put on their balance sheet so that they can fund the returns that they owe to policyholders. So now we need to find a ton of new stuff that we can originate and then we can put onto the insurers' balance sheets. So essentially, if you look at it, it's like that kind of like closed circle, right? It's, you look at an Apollo, it's, you have the insurer that they own, which is Athene. It's written a ton of policies. Oh no, I need a bunch of assets to be able to do the return from that. So Apollo goes out and finds all of this debt that it can then put back into Athene. And then Athene is like, oh, I'm doing these great returns. I can write more policies and so on. It's kind of a loop. And like, I mean, this is different for all of the managers. Like, people have like a different level of sophistication about how well they've been able to find those assets. Apollo is, frankly, at like the upper end of that level of sophistication. But everybody was really kind of staring down a barrel of, okay, interest rates are going down. The easy boom of direct lending, that whole buyout era is kind of ending. The easy boom of the beginning of this new era where we're trying to find all this safer stuff that, as I said, is kind of tied to assets is maybe getting a bit commoditized. Like, how do we keep finding these returns? The spreads, kind of as Neil was saying, like the amount that you can charge over a base rate for all of this debt was falling. And so like this was an industry that was crying out for something like AI. Like, if AI does prove to be a bubble, it will have found the most willing embrace possible from, a bunch of people. And this is also true for like the Trump administration eyeing poor GDP growth and all of these folks. Like, everybody was like so ready to accept a huge thing like AI that I think it's inevitable that it's going to go to a lot of places. So obviously, some of this debt is going to end up on insurer balance sheets. Some of this debt is going to end up, in your pension pot effectively. Some of this stuff is going to end up everywhere. And I think, Neil, you were looking at some figures about like where it's going in terms of like broadly traded funds and whatnot, right?
Sure. Well, yeah, one estimate I heard recently was that basically tech issuance could be a quarter of the US investment grade market next year, which just means that, yes, every single bond fund will have a very, very large exposure to it.
And I suppose that we started as well, Jonathan, right, where we talked about where people were concerned about just to what extent tech companies were taking up the equity market, just how big they were becoming. That was very hard to kind of insulate yourself from them. And now it looks like it'll be very difficult to insulate yourself from the debt exposure of this situation, right?
That's a really good
that's
point,
right.
actually.
Yeah.
No, that's totally it. It's just becoming the everything trade.
And I think that what I think you said, Jonathan, I think sort of really captures it. Is like how willing people were to embrace this. I think that's sort of like it's a sort of the perfect moment for AI, for this debt issuance, for it all. And let's hope that it doesn't all unravel before our eyes and before our pension funds. Neil, Jonathan, thank you so much. It's
Thanks, Amy.
fascinating.
Thanks for tuning in. This podcast was produced by Cheryl Pena in New York and Gregory Garner in Toronto. You can listen to a new episode of The Viewsroom every Thursday on the Reuters app or your favorite platform. And don't forget to tune in to our sister podcast, The Big View, every Tuesday, as well as the other great podcasts from the Reuters team. If you like what you heard, please follow The Viewsroom and let us know what you thought. We have a new email address where you can send us feedback, which is breakingviews-podcasts@tr.com. And check out our views on the biggest stories in business and finance every day on breakingviews.com and reuters.com.
Looking for more investing options? Meet Cboe, the exchange that pioneered options trading. With exclusive trading products like VIX and SPX options, Cboe can help you trade in any market environment. There are risks associated with Cboe company products. Review the disclosures and disclaimers at cboe.com/US_disclaimers.